The Trump administration has implemented a series of tariffs, igniting trade tensions with key trading partners. These tariffs, essentially taxes on imported goods, are reshaping the global trade landscape. One of the hardest-hit sectors is e-commerce, particularly businesses reliant on international supply chains. The US-Canada-Mexico agreement, once touted as a beacon of free trade, has been strained by escalating tariffs. Tariffs on goods from these countries have surged from 10% to 20%. This marks the third such increase under the current administration, signifying a protectionist turn in US trade policy. Tensions with China remain high, with existing tariffs from previous rounds of the trade war still in effect. These tariffs primarily target Chinese imports, impacting a wide range of goods from electronics to clothing. The ongoing trade dispute has created significant uncertainty for businesses that rely on Chinese suppliers. Adding fuel to the fire, the US recently announced plans to impose tariffs on various European Union consumer goods. These tariffs target products such as clothing, accessories, and home decor. In retaliation, the EU has vowed to impose tariffs on $26 billion worth of US imports. This tit-for-tat escalation threatens to further disrupt global trade flows. The consequences of these trade wars are far-reaching, impacting consumers and businesses alike. Tariffs, passed on as increased costs, are driving up prices for consumers on a wide range of goods. From everyday essentials to discretionary items, the price hikes are squeezing household budgets and fueling inflation. This rise in prices, coupled with the uncertainty surrounding the trade war, has dampened consumer confidence. Wary of economic instability and further price increases, consumers are becoming more cautious with their spending, particularly on non-essential items. This hesitancy is reflected in declining retail sales and slowing economic growth. The e-commerce sector, once considered immune to the headwinds facing traditional retail, is now feeling the heat. As tariffs drive up the cost of imported goods, online retailers are facing shrinking profit margins. Many are forced to choose between absorbing these costs and raising prices, a decision with significant implications for their bottom line. Dropshipping, a popular e-commerce model where businesses fulfill orders directly from suppliers, is facing unique challenges in the wake of tariff hikes. Dropshippers, often reliant on low-cost goods from overseas suppliers, are particularly vulnerable to rising import costs. Tariffs directly impact dropshippers by increasing wholesale costs, squeezing already thin profit margins. The situation is exacerbated by the uncertainty surrounding the $800 de minimis exemption. This exemption, which previously shielded low-value shipments from tariffs, is under review, potentially exposing dropshippers to even higher costs. Beyond rising costs, dropshipping businesses are also grappling with supply chain disruptions. The trade war has introduced instability and unpredictability into global shipping routes and customs processes. These disruptions translate into longer shipping times, increased risk of delays, and communication challenges with suppliers. In this turbulent trade environment, e-commerce businesses, including dropshippers, need to adapt to survive. While the situation appears daunting, several strategies can help mitigate the impact of tariffs and navigate the challenges ahead. First and foremost, businesses need to reassess their pricing strategies. While raising prices is never ideal, it may be necessary to offset increased costs and maintain profitability. Transparent communication with customers about these price adjustments is crucial to maintain trust. Diversifying sourcing strategies is another key adaptation. Exploring alternative suppliers in countries less affected by tariffs can help reduce reliance on high-tariff sources. Additionally, focusing on higher-value products with greater profit margins can offset the impact of tariffs on lower-cost goods. Finally, building strong relationships with suppliers is paramount. Open communication and proactive planning with suppliers can help manage shipping delays and ensure timely delivery to customers. Transparency with customers about potential delays is also essential for managing expectations and maintaining satisfaction.